All right. So, folks, when you're setting those goals, something that we talk a lot about at TD Ameritrade is making SMART goals. And when we talk about SMART goals, we don't just talk about them in regards to our portfolios. We don't just talk about them in regards to money. We talk about them in regards to career development. We talk to them in regards to the things that we want to accomplish as personal individuals. It's not always about money. It's about getting ideas on paper and making sure that you have accountability behind the things that you'd like to accomplish, whether it's financial or career or even education related. One time someone once said to me, a goal isn't a goal until it's on paper. Other than that, it's just a dream. So when we talk about getting goals on paper at TD, we like to make sure that they're SMART. And SMART is an acronym. The S is specific. And when I think about specific, you get that on paper, and if you can show that to your mom, your sister, your brother, they should be able to understand what you mean because you've nailed it down to a T. So that's what that specific word is. It really has to be defined, and it truly needs to be understood, not just by you, but your circle of people that support you. When it comes to being measurable, it really is going to help you stay on track. You have to be able to have those milestones. You need to have that scoreboard, so to speak, to be able to say to yourself, am I on track of reaching my goal? Have I taken the proper steps? Do I need to take more? You have to have some type of measure to be able to say whether or not there's being success made or whether or not you're taking the proper action. The next one is A, it's attainable. Attainable is more to me, more of it's like, is it realistic? Is it something that regardless of what happens, you have the ability to hit if you put in the effort or if you put your actual measurable and specific plan into place? If it's not attainable, it may not be something you should be striving for. Maybe you should, pull it back a little bit so that you can reach the successful milestones that you're looking for. It's just one of those things that you have to really evaluate. Is this something I really think I can hit? And if not, maybe you scale it back a little bit. Relevant to me is, do I actually care about what I'm striving for here? Like, do I have an emotion to this? Is this something I really care about? And if it's not something that you care about and there's not an emotion behind it, you may not put in the effort. You may not put the time in. And that relevant piece is very important because I think that's where the passion and the emotion comes from. And then last but not least, it's got to be time bound. Whether you're saving for that first car, whether you're dealing with a stock that you'd like to kind of see play out in your favorite way, there's got to be a time. You have to basically have a check-in to say, 1 week from now, am I achieving what I expected? And if not, do I need to change course? It's also going to help you making sure that your measures are in place so that when you actually look at these goals, you have the ability to say on track or not. Do I need to adjust? Do I need to slow down? Do I need to go faster? But having that time is going to help you with that accountability. And if you can put these things on paper, folks, share them with the people around you. Make them known to mom, dad, sister, brother, so that it's not just you that knows what you're striving for, but the people around you so they can help you reach the things that you're striving for. We love SMART goals at TD. We talk about them all the time. This is a slide, if you don't know or if you're not familiar with these, I think this will really help you guys as you're kind of defining some things that you'd like to accomplish. So with that, Bryce, I think I'm turning it back over to Cathal. Over to you, Matt.
And speaking of putting it to paper, we will pass it over to Matt with just a way to do that.
Cathal, you're muted.
Thank you. 2020, baby. You gotta love it. No, Josh, I love it. I really appreciate you sharing like the SMART goal. Like we do use it all the time, every day. And I always sit down with people I'm talking to, and I always tell them, like, think about like the long term. Like, what do you want to achieve? Like set that goal high, right? Wherever it is. But just know this, that you're gonna have those longer term goals. And then to meet those longer term goals, you're gonna come in along the way. And you're going to set baby steps, like your pinnacle's up on top of that mountain. We're all going to climb that hill, but we got to get to certain waypoints. And so like in doing so, like when you think about the plan for that, it's really setting up that SMART goal. And so, maybe it's, I want to achieve, a car purchase. I want to pay cash for a vehicle, right? And I'm going to, by accumulating X amount of money over the next 2-3 years, whatever it is, right? Well, that's great because now we've got our goal set. We know what we're going to do, but then we've got to put a definition behind it, right? And we've got to say, all right, what am I going to do on a daily basis or a monthly or a weekly basis that's going to help me get to this goal? And so that's where we're going to spell out kind of our actionable item, right? That thing that we use to keep ourselves accountable. And, to do this, I'll contribute, $50 each week to my, my savings account or my investment account. I would go with the investment account. That way you can start to make more money on it. But at the end of the day, and then manage your investments to pursue an annual, X amount of return when it comes to like I guess this is really related to like a different goal. Like this would be more of an investing goal versus a car, but same thing, like you're to pursue the purchase of said car. And the cool thing about this is everybody talks about coach or about SMART goals and setting these goals and attainables, but there's a reason behind it, right? So like when you think about like people who actually take the time to do these things, in most cases, you're going to start seeing like potentially like a 15% increase on your ability to expand your wealth, your investment. And I guess when I say wealth, at the end of the day, there's usually a purpose for that, right? We go back to our retirement, that car, that education plan, whatever it is. But the big picture here is you can get a lot of lift by really setting these small goals to reach that big pinnacle. I will turn it on.
All right.
Miss Rosie.
So we're going to talk a little bit about the 3 B's of investing. So we've got dynamics, diversification, and discipline. So just kind of breaking those down a little bit. Dynamics are going to include a couple of things, right? So the market, that's something that's always changing. It's really difficult to predict. It changes day to day. Life is dynamic, right? That's always changing. Some change is predictable, but some of it really isn't. Your goals are always going to be changing. Those are going to be evolving through time as you get into different circumstances, different times of your life. Those goals will change, as well as your needs, right? Your needs, those have to be met regardless of if we're in a bull or bear market. So those are things that are going to be, that's what you need. And then other factors, so interest rates, political factors, the economy. When we're talking about diversification, so this is a distribution of investment dollars across various asset classes and sectors. So the goal of this really is how can I spread my assets out and put myself in different things to reduce risk. So an example of this is, let's say that I had an account and I decided I'm going to throw everything into Apple. I'm just going to put it all in Apple and we're just going to run with it. But then tomorrow news comes out that, hey, something really bad happened with Apple, somebody's hacking them and prices are plummeting. This puts me at a lot of risk, right? Because I have everything in Apple and everything is dropping. So by diversifying, if I have, some shares in Tesla also, or Microsoft, or Home Depot, or other companies, that reduces the risk that I've taken on my portfolio. So, and you can also do this by buying different types of products and investing in different things like mutual funds or bonds, things like that. And then there's a discipline that comes into it. So discipline is making sure that you're reviewing your portfolio on a regular basis. Like we mentioned earlier, those dynamics, things are always changing. Life is always changing. Your goals are changing. So you want to make sure that whatever you're investing in, whatever those goals are, that you're keeping up to date with those and making sure that whatever you're investing in is matching up with what those goals are. That's going to change over time. So your investment should be changing as well.
Cool. So then let's look at the investment process as a whole. So we talked a lot about goals already. You got to have goals, but then there's other aspects of it. You for sure want to establish your budget. This is going to be important. You're still going to need money to live on. Pay bills, pay for college, whatever it might be. But then when you look at your budget, you're going to want to set some money aside to start investing. So maybe look for things that you can cut out. Set some money aside, get your budget set, and then get a plan in place. You want to consider what types of investment accounts to go for, and you might end up having multiple. For example, if one of the goals you set is related to retirement, you're probably going to want to look at a retirement account like an IRA or Roth IRA. It's going to be money you set aside, invest in over a very long period of time that you're not going to touch. But say you have a goal to buy a house in 5 years or whatever, like buy a car in 5 years, you're probably not going to be looking at a retirement account. You might be looking at just a regular individual investment account. That's going to be money that you can pull out anytime you need it. And then once you consider those factors, you're going to want to decide what to invest in. Again, looking back at your goals, this might kind of help you decide on what to invest in. There's many different investment vehicles you can go for. There's stocks, there's money markets, mutual funds, and they all have their different risks. They all have their different, returns, possible returns. So it's all something you want to take into consideration.
The last thing that we'll really talk about here is the importance of staying and invested. And I think the biggest takeaway from anything that we're talking about here, and something that's important to look at as we look on this slide, is that when you think of the scope of your life and you think of the next 20, 30, 40, 50 years of your financial future, the biggest takeaway here is that having a successful future financially is not a wish upon a hope upon a star. Each one of you have the ability to take into your hands the control to not be relegated to your financial future being based on the paycheck you get from your job. You have the ability to start today. There are accounts, even if you're not the age where you can open your own account, there are types of accounts where you can get with a trusted adult, you can get set up today. There are things you can do right now, even if you only have $5 to start with. There are things that you can start doing to set yourself up right now so that when you get to later in life, you don't have to wait on a specific job. If you don't like your job, you're going to have some money to the side. You can say, you know what, I have income coming from a different stream where if I don't feel comfortable doing something, if I don't like these people, I want to get up out of here, you have that flexibility. So the biggest takeaway here is just get started. Just do something. Get involved. If you like Apple and you think that the new the AirPod Maxes are the greatest headphones that are ever going to happen, it's going to revolutionize the rest of the world. If you believe in that, go pick companies you believe in. It's not this complex science that you need day one. You don't need to have degrees and schooling and all this education. Just get started with it. And what you'll see here with this chart is once you get started, just make sure that you just keep on doing it. If you look here over a period of time here, these are somebody who got out of the market, somebody who got out of the market and got back in, and someone who stayed in the market here the entire period of time. And if you look, who did the absolute worst, the person with $54,000 or so dollars, they got out of the market and they just sat in cash. They weren't actively investing. And I don't know about you, I wouldn't be mad at having $45,000. That's not a bad thing to have. But when you compare it to someone who has $174,000, that's because they started and they stayed with it. They didn't let what's going on in the world scare them or make them hop out of the market when things got bad. They didn't go, oh, I'm going to try to time things. Just every day they were actively investing and they kept with it. And over the period of time, that has resulted in a positive increase in their overall net worth.
All right, and I will go ahead and round things out. I want to give you guys some actionable items and some things you can do, as Jacob mentioned, to start your investment path and start your financial futures. We actually have demo paper money accounts that can be open for 60 days. We oftentimes use these with our young college students. Sometimes we'll do these trading challenges where we'll get involved and we'll see how well some of our college students are doing. So we do have the ability to open up paper money accounts where there's no age requirement or funding. It's essentially like playing the stock market challenge, but getting to use our platform and kind of see how it works out and be a part of the TD Ameritrade trading process. Also, as Jacob mentioned, if you have a trusted adult or someone that has the age of majority, someone that is maybe a parent, maybe a guardian, someone that you trust, they can always open an account and get you added to their account under a custodian area, and you can start doing some small trading, and the money that you have, you can actually start investing in some companies you want to. And then one thing that you can always do, if you ever just want to learn more, if you ever want to just kind of get out there and see what you want to learn, TD Ameritrade has plenty of free education courses, videos, and demos. So we have the link right there. So if you go to tdameritrade.com, you'll actually find several videos, demos, things that get you started. And I promise there's many people out there that don't even know what a stock is. So you guys are already well ahead of it. You've already been a part of it, and definitely encourage you to keep staying engaged in your schoolwork, keep asking questions of your teachers, and you can always reach out to us. We have a pretty good relationship with a lot of your guys' teachers and a lot of the folks that are working at the club. So if you ever have questions, never hesitate to ask them, and they can always relay them over to us. And I think that's a perfect segue because we are now at time. So I know we went over a little bit, but we have some time for some Q&A. So if you guys have questions, feel free to shoot them out. You can either use the chat or just yell them out, and we can answer them.
I'm sure.
Guys can't be quiet now.
Questions.
You guys feel better about the stock market and investing? Some of the stuff we shared with you guys today make more sense than maybe in the past when we've done the stock market challenge. A little bit more clarity now.
Guys, while you're thinking about questions, one thing I'll say is this. For a lot of us, we've been in this industry. We've been doing this job for a very long time, and I would not consider any of us great at investing. It takes continued effort, lots more education. It takes a lot of time. So yes, we speak today about some of these great ideas, and we definitely have some things that have worked for us. But I can tell you that we're all going to continue to go out and learn more and educate ourselves more. It's one of those ongoing things that just can't stop if we're going to continue to be successful. So I think whether it's like Jacob talked about, whether it's starting with a goal today and getting money in the market today, it's one of those things where you just need to start looking into this a little bit more today, and it will continue to grow for you, and you'll continue to learn more. But I'll promise you, you're never going to quit learning when it comes to things like investing.
Dale's got a great question.
Just to add to that real fast, like one of my biggest regrets is not starting to invest earlier in life. I still regret that. Even though I'm in the industry now, I've always regretted not starting earlier.
Jacob, you going to answer Mikhail's question?
I got you here. So that's a great question. So the question is, where does my money go when a stock goes down? So the way that would work is no different than anything else that you buy that might go up in value. Whether you're like Josh Klassen on the call, you collect sneakers, whether you're buying a house, anything like that. When you go into the marketplace and you buy a stock, let's say you have a TD Ameritrade account, you want to buy the stock. You spend the money would be out of your account. You purchase that stock at the time that you hit buy, that trade goes through. You bought it, the money's gone. Really what determines that value is, what can I sell it for at any given time? So in the industry, and when we talk about taxes, there's something called unrealized or realized gains. At the end of the day, you never actually lose money until you sell that thing for less than you bought it for. So maybe for the next 3.5 years, the value is way low. And on paper, it looks like I lost a lot of money. But after that 3.5 years, the value goes way up. And when I sell it, I made money. Really, you don't lose or gain anything until you actually sell the item itself. So when it comes to your specific question about it being coming out of your bank account, that's going to happen at the time of purchase. You're going to take the money out. You're going to say, I'm going to buy this stock. I'm going to buy these sneakers, whatever it is. I'm going to buy this thing. And it really doesn't change in value until I actually sell it. So if I sell it for more, I made money. If I sold it for less, I lost money. If I sold it for exactly what I bought it for, I came out neutral. But there's no actually money changing hands until that actual transaction.
That's a great question. We get that question a lot. I know my reps on the front lines as brokers get that question a lot. So thank you for asking that.
I thought I saw another question pop.
Oh,
I thought I saw another one. I don't know how to pull them up though.
Nathan, so Nathan says, so do you have to have a lot of money to invest in a stock? Garrett Buss, you want to answer that one?
Do I have to have a lot of money to start investing? No, the step is just start with a small amount. And there's a lot of different ways you can do some smaller investments. The key is to just start.
Even the Warren Buffetts of the world. Yeah, even the Warren Buffetts of the world and all the wealthy people in the world, they all had to start somewhere. So it's just that first trade and just getting started. You know, there's no right or wrong time to get started, but if you wait too long, you're missing out on some opportunities to make money. I know that compounding interest, which we won't get in on this call, but let's just say that it's definitely the sixth wonder of the world.
Well, and guys, the big thing to think about there is this is something that my dad always said to me was basically save more than you spend, right? It sounds really stupid when you hear it, but like at the end of the day, if you've got an account there, right, just work towards getting, like, let's say by the time you're 25, you want to have 6 months worth of what it might cost you. Let's say it costs you $1,000 a month to live. Well, if you start putting away, $5, $10 a month and really accumulating that, right, then you're going to be able to invest with it. You're going to be able to do those things. But then to Jacob's point earlier, it's going to start to give you that feeling of financial freedom, right? Because then you get to call the shots for yourself, right? You don't have somebody who, where you just feel like beholding to whatever it is that you have. It's like now you can go out. And the cool thing is you can go out at that point, choose what you want, but then also share that, right? Take that to other people, right? That principle has served me really well in life. And like Travis's point, like I wish I would have started investing earlier, but ultimately, like the big picture is really just saving it and getting started.
I think a good takeaway is that say you get a paycheck and the paycheck's $50 a week or whatever it is. If you can just take $5 or $7 or $10 out of that paycheck and put it into an account, have it automatically go into that account every paycheck, you won't even know it's gone, and you'll see that account grow steadily over time. Mm-hmm. And again, it's that process of just doing a small thing and having an auto pull to that account is a great idea.
Mikkel, that's a great question too. He says, and what happens when the stock goes up and down? How does it affect the owner? You my friend, have hit on the number one issue in the stock market, which is emotion. And that's probably the biggest thing that we want to try to eliminate with the market. I think that the chart that Jacob showed is a good example of that, right? You have 3 investors who essentially were at the same point as far as putting money in. And you have the one who stayed in and he went down, but he didn't let that emotion get to him. And at the end of the day, his account grew exponentially more than everyone else's. That person who said, oh, I'm going to dump out, I'm going to get out, and then I'm going to get back in, he still did well, or she still did well, but at the end of the day, not as well as that other guy. Whereas that person who just dumped out and was like, yeah, they let the emotion infect them too much, and then they were scared to go back in, right? And it's a big balance game. It's probably the biggest thing, but I think it goes right back to kind of what we were talking about with goals. Like setting a strategy for what you're doing in the market. I mean, I trade a lot. And at this point, though, I still have on paper my rule for what I do so that I don't let emotion impact. Great question.
And Mikhail, you've probably felt some of that emotion before during the stock market challenge. Even though it may not be real money, when that day flips over from trading day, whatever, to the next day, if your account took a hit, believe me, we all reacted. At least the groups that I've worked with in the past react. So believe me, emotion's a real thing, but it's just good to stay true to your principles and the things that kind of guide your investment goals.
Nathan's got another one. So is there such a thing as a bad stock or a good stock? Who wants to take it?
I can speak on that one a little bit. So really, the beautiful thing about the markets and the way that it works is at the end of the day, it's an auction system. So someone's always buying, someone's always selling. A trade never happens unless someone thinks something bad is about to happen to that stock and they want to get out of it, and someone else thinks something great is going to happen to that stock and they want to get into it. So I would say the objective answer is no. There's no such thing as a good stock or a bad stock. There's just how do you feel about it? You and I might look at the same stock and think wildly different things. For instance, I'll use the Apple example. Apple came out with new headphones. I think they're the dumbest headphones that have ever come out in the history of the world. I don't think they're very good, but someone else might look at those and go, those are awesome headphones. And not only do I want 2 pairs of them in 2 different colors with the custom cups and the whole 9 yards, also, I think that Apple is going to make so much money off of that. People can have wildly different views on the same company. So someone might be like, I don't want to touch that at all. That's terrible. And someone else might be, hey, in 10 years, that's going to be something. So we can't tell the future. If I could tell the future, I'd be on the beach right now. But really, you have to look at each individual company and say, how do I feel about that company? Do I feel this is going to be worth more in some period of time? And what's my personal assumption and my personal assessment of that company? I wouldn't say there's a hard good or bad. In hindsight, the answer is going to be clear. It either went up or it went down. But as we look to the future, you just have to make decisions on how you personally feel and where you find the risk and where you're willing, the decisions you're willing to make about that company.
Great questions, guys. So I know we're a little bit over, so Jonah, I want to make sure that we're keeping track. I'm not sure when our hard cutoff is, but I want to make sure that we're being diligent with the time you've given us.
Yeah, so again, thank you so much for answering all of these amazing questions. And thank you so much for the members for asking amazing questions. I'm looking at the chat now. So I see Nathan, I believe, just put in another question too, or I don't, maybe
We got a couple more.
lagging a little bit. So we could actually start wrapping it up. I know Nathan just had maybe one more question. So Nathan, your question will be the last. And then if you guys have more questions, the members, you guys have my email and I can make sure that your questions get answered. Does that sound good to everyone?
Heck yeah.
Okay.
Yeah,
That works.
absolutely.
So Nathan, your question is, so do you think it would be better to invest in a stock while it's doing good or while it's doing bad? And does somebody else want to take this or I will? It doesn't matter.
I've tried both.
Right. I think there's
I've tried both ways.
There's a lot of schools of thought to that, right? Like what we were talking about earlier, like we look for value, right? So you think about like an investor like Warren Buffett, right? So Warren Buffett is traditionally known as a value investor. So he's going out and he's looking for companies that have a ton of potential. They have a ton of opportunity, but their price is lower, right? So some people might think that, oh, well, they're doing bad. The company may not be doing bad, but the stock price may not be where it is. That's typically something that's undervalued. That would actually, in a lot of cases, be a good time to buy, depending on whether or not that company has a good long-term forecast on what they're going to do as far as profits and growth and revenue. So that's a good question. What do we got there? Let's see.
Great. So I believe, sorry, I'm still looking at the chat. I believe Nathan had the last question.